Now then, let's start with the business of private equity. Steady, incremental growth is a most likely trend you should expect from private equity activity in Africa in 2013 and most likely in 2014 as well. Let me explain what I'm talking about for starters. Let's look at these numbers here. 2011, just about $3 billion worth of reported deals, but in 2012, the figure drops to just over $1 billion. Now, preliminary data from Africa Assets suggests that in 2013, the number of deals went up again by about $500,000 or so. But the question you're probably asking is, what explains this dip? Here's one of Africa Assets directors, Keeler, explaining why.
I think that there was just low investor confidence around the world. Probably at that time in Africa seemed like a riskier place, but I think it may have also just been that 2011 was a boom year, because 2012 and 2013 have been more consistent with what we've seen in the past, with this sort of steady growth over the last 5 years, but not explosive amounts of capital being invested. So I think we've sort of returned to a more normal trend.
Now, the preliminary 2013 data from Africa Assets also suggests that one of the trends that we saw in 2012 is still very much in force. You see, in 2012, quite a bit of money in the private equity deals went into East Africa and West Africa. If you look at the breakdown here, the bulk of it actually came into East Africa, $474.6 million. West Africa coming slightly lower than that, 298, but Southern Africa, despite of course South Africa having the best developed financial markets in the entire continent, not getting that much play. Now, one of the reasons for that is you've got mainly higher GDP growth rates available in these two areas, even after taking political risks into account. So that's the money. Where exactly was it going? Several sectors here: financial services, manufacturing, agribusiness, and healthcare, in that order across sub-Saharan Africa. But there is one key sector which is notable here for its absence. There's been plenty of hype about the Silicon Savannah in East Africa, but as you might have noticed, virtually no deals in 2011 and 2012 in East Africa. Here's why.
I think that has to do with the scale of the market there, and there's also, because of the size of the market, you have more serious investors going in there, guys who know how to build companies. As opposed to in East Africa, it's this very different culture, and it's all around the iHubs and the incubators, and it's all about young guys who want to build apps and young techies, and those guys don't know how to build serious businesses, so no one's going to hand them $20 million to take their app into the market.
So, put another way, being a coder is not the same thing as being able to actually be the next Mark Zuckerberg. Finally, though, private equity activity is spreading right across Africa's economies. You're seeing a lot more diversity in the kind of deals that are being done. Watch out for energy funds in 2014, for example, and the countries in which these deals are being done: Tanzania, Cote d'Ivoire, Rwanda. That said, most private equity deals in Africa are still very heavily dependent on funding from development finance institutions. The question is this the year that might change?
Watch going forward in 2014 is to look at whether PE funds can finally unlock this holy grail of local capital, which they've been talking about for years, which is local pension funds, local insurance companies. And those are the investors that have driven PE growth in other markets. And so that is what really needs to happen in Africa to see serious growth.
And of course, once the final analysis is out from Africa Assets, you can see it right here first.